Welcome back to Investing Talk Podcast.
Today we're looking at United Health Group, the healthcare giant that often acts as a bellwether for the entire U.S. health system.
And we've dug into the latest analysis to really understand where this company sits today. As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, so let's get into the analysis. When we talk about this name, I think you have to start with its core structural advantage.
The vertical integration.
Exactly. This isn't just an insurance company anymore. It's a true hybrid model.
Right. You've got United Healthcare, which is the traditional benefits side, and then there's Optum.
And Optum has just grown into this massive health services, pharmacy, data conglomerate. It's really the two pieces working together.
It feels less like two separate businesses and more like a carefully engineered ecosystem.
That's a great way to put it.
Where the insurance side sort of feeds the services side, and then the services side makes the insurance side more efficient.
It's a flywheel effect.
Yeah.
And the power of that flywheel is, it's best shown by Optum.
That's the undisputed growth driver, right?
Oh, absolutely. In the first quarter of 2025, Optum Health revenue, it grew 15.1% year over year. That's up to $39.4 billion.
Wow.
But the number that really had analysts buzzing was the operating margin. It expanded significantly, hitting 8.9%.
And that 8.9% margin for Optum Health, that's huge, especially in, the notoriously low margin world of healthcare services.
It is.
So how are they pulling that off? How are they achieving an efficiency that their peers just can't seem to touch?
Well, it really comes down to two things: scale and data. Optum is serving over 40 million patients directly.
Through its own clinics.
Through its own managed clinics, home health services, you name it.
And when you control both the payment mechanism and the delivery mechanism.
You can just optimize everything in real time. You can. You can manage patient care pathways so aggressively. And that creates this incredibly high patient stickiness.
So they aren't just paying claims anymore. They're embedding themselves deep into the actual delivery of care.
Which is the most expensive part of the whole equation.
But the moat isn't just about controlling the clinics, is it? It's about the information highway itself.
That's the other half of it. The data services arm, Optum Insight, is providing these proprietary AI platforms to, get this, 90% of the top 100 health plans in the U.S.
So they're selling the tech to their own competitors.
Think of it this way. Optum is positioning itself to be the operating system for the entire U.S. healthcare sector.
A huge barrier to entry.
It's almost unparalleled. If you wanted to compete just on the insurance side, you'd have to build a whole tech stack that Optum already owns and sells.
And that scale, that efficiency, that's why the financials have just been so robust. It underpins the whole bull case. That Q1 2025 performance, revenue hit $99.3 billion. That's a nearly $1 trillion annual run rate.
And it beat consensus handily. Adjusted EPS of $6.01 also came in well above expectations.
And when you have a strong quarter like that, it tends to breed confidence for management.
It certainly does. That Q1 beat gave them the confidence to significantly raise their full-year guidance for 2025.
They bumped up the adjusted EPS range to, $25.70 to $26.20.
That's right. And that was a material upward revision from their prior guidance. It signals they see, durable structural growth ahead.
Mostly from that services segment.
Primarily from Optum, yes.
Okay, so let's talk about the fuel for that growth engine, cash flow, the balance sheet. This company is a cash-generating machine.
Absolutely. The financial health is, it's stellar. And it's driven by that tremendous free cash flow generation.
How much did they do in Q1?
In Q1 2025 alone, they generated $7.3 billion in free cash flow.
Just in one quarter.
In one quarter. And to put that in perspective, that was 74% of their net income. A very, very efficient conversion rate of profits into cash.
So where does all that capital go? You mentioned deployable cash, and that seems to be the key.
Right. They deployed it pretty strategically across, let's say, three main avenues.
First was buybacks, I assume.
Yep. $2.8 billion went to share repurchases in Q1. That's management basically saying they think the stock is undervalued.
And they also bumped the dividend, which keeps the income investors happy.
7.3% raise year over year. But for the long-term picture, the most vital part was the reinvestment.
Back into the business.
$2.2 billion straight back into Optum, into infrastructure, new clinics, and enhancing their data analytics. They're actively feeding the golden goose.
And if we just look at the pure liquidity, it's very reassuring. They were holding, $14.1 billion in cash and equivalents?
And more importantly, their net debt-to-EBITDA ratio stood at a very healthy 1.8 times.
Okay, so why is that specific number, 1.8 times, why is that so important for an investor to know?
Well, it matters because the industry median is way higher. It's closer to 2.9 times.
Oh, wow.
So a debt ratio of 1.8 times means they have a super clean balance sheet. They have a massive amount of dry powder.
So a big acquisition opportunity comes up.
They can move fast. They can be strategically aggressive without stressing their capital structure at all.
Now, if we connect that financial strength to market sentiment, we have to talk about insider conviction. Something big happened back in March of 2025.
Oh yeah, the $12 million stock purchase by the CEO. That definitely caught my eye.
Talk about putting your money where your mouth is.
And the context is what's really critical there. It was the first insider buy from the CEO since 2020.
That's a huge signal.
It is. When the person who knows the company best puts that kind of personal capital on the line, especially after some volatility, it sends a powerful message.
And the CFO also added $5.4 million. So it's alignment right from the top.
They clearly believe the underlying business is stronger than what the market was perceiving.
And that conviction isn't just in the current operations, right? It's about future efficiency.
Right. Future efficiency driven by technology. And that brings us to that key strategic move announced in April 2025, the partnership with Amazon Web Services.
This is the generative AI piece. They're using it for real-time prior authorization decisions.
Across 80 million lives.
So for our listeners, why is prior authorization such a massive headache, and what does AI actually fix here?
Prior authorization is just the bane of the medical industry. It's that administrative hurdle where insurers have to approve a procedure before it happens.
It's slow, it's expensive.
It's a source of constant friction. By using generative AI, they want to automate and speed those decisions up, turn days or hours into minutes or seconds.
So it's a massive cost reduction catalyst. Cuts down on administrative waste, boosts margins.
Exactly. Boosts the margins on the insurance side directly.
And on the technical side, the stock itself, it showed some really strong momentum earlier in the year. It confirmed a golden cross.
Right. For those who don't follow the charts, that's when the 50-day moving average crosses above the 200-day. It's a classic technical indicator.
Often signals that momentum is accelerating into a longer-term bullish trend.
And the institutions were buying into that momentum. Major asset managers, the BlackRocks, the Vanguards.
They were all increasing their holdings in Q1.
They were. And that widespread institutional support adds some serious weight to the overall bull case.
Okay, so that's a pretty compelling story. The structural moat, the cash generation, the insider confidence. But no company this big, especially in U.S. healthcare, is without significant risk. So if we flip to the bear case, where does the volatility come from?
The primary risk, the one that investors have to monitor constantly, is medical cost trends, utilization rates.
Yes, this is the single biggest factor that can shock the stock.
Always is. And the data here, it is a bit concerning. For the first 6 months of 2025, medical costs surged 15.8% year over year.
$152 billion.
Huge number. And that increase, it reflects higher use of services, more elective procedures, higher than expected claims, especially in the Medicare population.
Which brings us to the metric everyone watches, the medical care ratio, or MCR.
The MCR. It tells you exactly how much of the premium revenue they collect is being paid right back out in medical claims.
And if that number gets too high,
the company loses money on insurance. Any sustained spike in utilization, like we saw hints of this year, puts immediate pressure on margins, and historically, it drives major price reactions in the stock.
it's a constant tug-of-war.
It is.
The other major headwind, and this one feels like it's never going away, is regulatory scrutiny.
It's not new, but it is getting more intense. The Federal Trade Commission, the Department of Justice.
They're still investigating Optum's dual-payer provider role.
That's right. The concern is over what they call anti-competitive bundling.
And the core issue is basically a question of whether the company is using its huge insurance platform
United Healthcare.
to steer millions of its customers exclusively to its own Optum clinics.
Right. And if they're doing that too aggressively, independent providers argue they're being squeezed out of the market unfairly. It raises questions about the integrity of that whole integrated model we were just praising.
So even if the stock price doesn't reflect any distress right now, the potential for long, expensive legal battles,
Or worse.
or worse, some kind of structural mandate that forces them to change how the model operates.
That remains a permanent, persistent risk that just kind of clouds the long-term outlook.
And we can't forget about other uncertainties, right? integration challenges from pending acquisitions, policy shocks.
That's a big one, especially with Medicare Advantage rates. If federal rules change and result in unfavorable rate adjustments, the company might not be able to offset those costs right away.
So let's pivot to where the conversation is headed now. Let's talk upcoming catalysts and watch points, especially after the Q3 results.
Well, the Q3 2025 earnings were released on October 28th. And the market's reaction, it wasn't just about the numbers themselves, it was the commentary.
Right. Analysts were laser focused on updates to the full year guidance
And the trajectory of Medicare Advantage growth. That's ahead of the crucial annual enrollment period.
And why is Medicare Advantage, or MA, so critical for this specific company?
Because that's where the vertical integration model really shines. It delivers the most substantial profit margins there.
It's a captive market.
It's a captive market where they can truly maximize the use of all of Optum's services. So strong MA enrollment, it validates the entire strategy.
Okay, so looking ahead into Q4, what are the external catalysts we should be watching?
Well, there's the major ETF quarterly rebalancing toward the end of November.
Just because of the company's sheer size and weight in the indices.
Exactly. Any shift in index weighting can affect passive flows, which can mean billions of dollars moving the stock for reasons that have nothing to do with fundamentals.
And then the real window into long-term ownership comes in December.
Yep, the institutional 13F filings. They're due around December 15th.
And that will tell us if the big funds kept buying through the back half of the year.
Right. Did they maintain their conviction after digesting all those reports about utilization trends? We'll see.
And very long-term, it seems like the company is just squarely focused on driving that Medicare Advantage enrollment for the 2026 plan year.
They are. They're capitalizing on their scale and their differentiated model to keep taking market share.
So when you put it all together, what does this mean for you, the investor?
I think the company remains, structurally positioned for strong fundamental performance. That vertical integration moat and its immense free cash flow engine, that gives it a very defensible, durable advantage. But that durable advantage comes with durable regulatory risk. You have to treat this as a bifurcated investment.
You're betting on Optum's growth,
while hedging against the risk that the insurance side gets blindsided by utilization spikes or, a policy change out of Washington.
So the watch points are clear: MCR trends and any headline from the FTC or DOJ.
Exactly. This company operates at the nexus of finance, technology, and policy. So to understand its future, you have to monitor not just its balance sheet, but also the political and social climate around healthcare in America.
Make sure you subscribe to Investing Talk podcast so you don't miss our next deep exploration into the forces shaping your portfolio.